Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Welcome to another one of our interviews. Today we're very lucky we have with us Nick Greenwood, who is manager of two funds. One is the Miton Global Opportunities Investment Trust, and as you know, MoneyWeek is very keen on investment trusts, and this is a fund of investment trusts. So lots of interesting stuff coming up from that. He also runs a similar fund, which is open-ended, which is called the Miton Worldwide Opportunities Fund. So I think we'll put that one to the side for 1 minute, and we will talk mainly about investment trusts. So let's talk about why you run a fund of investment trusts.
Well, the fund has evolved over the years. It did actually start as a fairly ordinary fund of funds, but over the years it's evolved into basically a special situations vehicle, focusing on the sort of less well-known, overlooked corners of the trust market. There's some incredible inefficiencies. So the typical fund at the moment is trading on a 29% discount. So
let's just explain that. When we say it's trading on a 29% discount, we mean it's trading on a 29% discount to its net asset value, i.e. the actual value of all the things
inside. So if the portfolio is £1,
yep,
I'm able to buy them in the open market at 71 pence. Okay. So I'm buying
bargain.
Yeah, I'm buying overlooked assets at a very cheap level.
Yeah, but only a bargain if the price ever goes up for £1, right? Otherwise, it's really not a bargain at all.
The day job is working out what the true value of the portfolio is, and the closed-ended world is moving more to being a natural home for alternatives, where the calculations are more subjective. And German property is probably the most extreme situation, where the methodology values a couple of investment trust portfolios as though they were rental properties, which is exactly what they are. But in Germany, most people rent, therefore most voters are tenants, so you have a lot of landlord-unfriendly rules, regulations. If you're able to take that rental flat and convert it into the private market, sell it on as what we know as leasehold, there's an enormous difference in the price. So typically in Berlin, the rental average is something like 1,880 euros a square metre. You can sell those flats as private over 4,000. So the net asset value takes the rental figure, but of course our view is that these flats will be sold over the next few years into the private market at a big premium.
And why will they be sold?
Because the managers have got permission to convert these from rental to private, and then they will liquidate the portfolio over a period of time and hand the money back to the investors. Yeah.
So this is simply a play on changing regulations and changing
it's
ways
moving
of
away from the
property.
debt out of regulation, which gives you extreme value. The investment trust world is used to treating stated net asset values as verbatim, because historically they were mainly equity funds, and you just run your Bloomberg and you know what the NAV is at the end of the day, taking the closing prices of all the equity holdings. Using that Berlin property as an example, the valuation process is subjective, and sometimes you get a big difference between the stated NAV and what these assets would be worth in the real world, but the market still tends to follow the stated NAV, creating an enormous inefficiency. And that's how I fill my days, looking for these sorts of things. Yeah.
And it's your top holding at the moment, this
No,
trust?
it's not. Taliesin is my second largest holding. Recently, India Capital Growth has become my top holding.
Okay. Now, we weren't going to talk about the trust first. We were going to talk about why investment trust as opposed to specific. So let's go back a little bit to why investment trust. So the first reason there is you're saying that this is where the value is.
Yes.
There are trusts trading on big discounts because there are now people who invest in funds in general now too big to look at the smaller trusts, which leaves inefficiencies in the market for people like you with much smaller amounts of money to pick up.
Yeah, I mean the important difference between an investment trust and open-ended fund is the fund manager is protected from inflows and outflows, which means if a sector falls out of favour, he's not forced to go into the market and take very poor prices. We've had quite a high-profile example recently with property open-ended funds, which is a prime example of what happens if you own a liquid assets in an open-ended fund where the investors can walk at 24 hours notice, but the poor fund manager can't do the same in the underlying
so stuck
portfolio.
With
so you get
buildings.
This fatal mismatch.
Yeah. He can't sell them fast enough to return the money to shareholders, so suddenly we end up having to close the funds, right?
So, exactly. So an investment trust doesn't have that problem. Your entry is in the market. You can sell those shares in the market, but because there aren't inflows and outflows into the fund itself, the fund manager can sit on those assets and he's not turned into a false seller and value destroyed. So investment trusts I view as superior investment vehicles, but they're just not user-friendly.
So they're superior investment vehicles for us, for the retail investor, because it's much longer-term capital. We know that the fund manager has the ability to invest properly for the long term. And he can also, to a degree, he can ignore how much everyone gets at him if he's underperformed for a couple of years, because the capital just stays there. So as long as his directors are nice to him, he's good.
And directors are often nice to the fund managers.
Are they? Why? I mean, it's a director's job, surely, to chivvy the fund managers along, not to be too nice to them.
Yes.
It's been a long-term problem in the investment trust market, right? Directors being just a little bit too nice.
Historic, yes. It's changing compared to experiences 10 or 15 years ago where very often it was quite a cosy club. You know, the directors are more challenging.
Yeah, I mean, I always think one of the great advantages of investment trusts is that they do have the directors there whose job is to protect the shareholders. And an awful lot of funds, particularly open-ended funds, are not really run for the people who hold the units. They're run for the company that manages the fund, and that's where the money goes, right? But with an investment trust, you can look at the directors and say, hang on, guys, maybe guys, I'm afraid, it's your job to protect the shareholders, not to protect the fund manager. It seems to me to be one of the great things about an investment trust.
Yeah, and I think it's probably truer today because in a more litigious world, directors are more vulnerable. So they take on the responsibility of the director of an investment trust. It's, you know, you are vulnerable, you are at risk, and therefore you're going to have a much less cosy relationship with the fund manager than you would have 10, 15 years ago.
And for disclosure purposes, I should say I'm a director of 2 investment trusts. So that was just a disclosure, readers. But I think the readers know already.
But the downside, whilst they're superior investment vehicles, are not particularly user-friendly. And this is what's causing all the disruption in the pricing at the moment. Because historically, the old private client stockbrokers used to be the buyers of investment trusts, and the IFA world used to buy the open-ended funds. What's happened is that those maybe 100 companies that were the member firms of the London Stock Exchange, the old Shepherds and Chases and the Greaves and Grants of this world, have all been merged into these vast chains. You know, the Investex, the Bruins, the Rathbones. And they're looking to increasingly standardise portfolios. So the problem now is
which makes sense because that's a lower cost way of doing things.
Exactly. There's a regulatory push and there's a commercial push to standardise portfolios. But that makes life difficult for the investment trust movement because these companies now, you know, individually might have been running $1 billion. They're now part of a vast empire running $25 billion. And if you're trying to standardise across a whole range of portfolios, you need to buy a lot of stock in the market at any one time.
So if an investment trust has only got a total market capitalisation of, say, between 70 and 100 million,
well, I think
if you wanted to put all your portfolios in, you'd buy the whole thing.
Well, probably several times over. So really, I mean, the industry has said it's £250,000, but really, if you think of the size of these vehicles, even a £250,000 investment trust will be difficult to buy and allocate. So the bar steadily rises. So 400 million is the figure I look at. And if you say there are around 450 investment trusts, 360, 370 are below that bar. So the problem is these are listed vehicles. The natural buyers are moving on, and therefore they've got to find new buyers. And that may well happen in time. But if you're listed and you have no natural buyers, there's a few sellers, your share price will keep falling. And liquidity is worse than it used to be. The market makers are not putting up as much capital behind markets. And this is how you end up with being able to buy stocks at 71 pence in the pound when the vehicles are actually doing nothing wrong. It's just that their client base has moved on.
Yeah. But, what changes that dynamic? You end up with something that costs you 70p in the pound. Those natural buyers aren't going to come back in the market. There's a limit to how much money we readers can buy. So when does that price go up again?
Normally, sadly, the most common exit from my fund is the end of the underlying fund. If you're buying something that's already trading on a 30 discount, they are in the last chance saloon. So, and we've had examples this week, if something else goes wrong, or just exhaustion, then the trust will very often go into an orderly wind-up. And probably half of my exits come that way. Others, now if you could actually find something that finds a new client base or a new manager or a new reason to exist, a new audience, you can get a powerful combination of a rising NAV and a narrowing discount. And if you just do the sums of buying something at a 30 discount when it moves to 10, and you get a 10% move in the NAV, you can get a spectacular move.
Yeah, and we saw this recently. There was a little trust, Aurora, now called, which was a disaster under its previous manager. It was taken over by Gary Channon at Phoenix, right? And immediately the discount closed.
Yes.
And now it's trading at a premium.
Yes, because there is.
So everyone got an immediate kind of 35% uplift there.
Yeah.
Including MoneyWeek readers, by the way.
Yep. No, that's one of our core holdings. I mean, that one actually trades at a premium, but we're just purely backing the managers. And the situation there, they've got a good long-term record, but most of their funds are in obscure offshore locations, and they really wanted a vehicle that their fan club that could only buy UK vanilla vehicles could access. So the trust is very small, and that allows them to grow the trust, and therefore there's more demand than there is supply, because the trust is very small in the first place, and hence we trade on a premium. The other important point with them is they run very concentrated portfolios. Yeah. So the ability to be closed-ended, again going back to the inflows and outflows, if you've got to have a 10-stock portfolio, you really don't want to be hit with redemptions and having to go across and sell a very short range of underlying stocks.
Well, I'll tell you what, now we're on Aurora. Let's move on to the subject of fees. One, because Aurora has a performance-only structure, right? Yeah. Now, in the past, everyone has bandied around numbers showing how investment trusts have generally outperformed open-ended funds over time. Yeah. And people have argued about why that is. Is it because managers are so good at dealing with their leverage, or is it actually just because in the end the fees have been lower? The overall cost has been lower because they haven't gone through the IFA system, the commission system, etc. But now that that's all changed post-RDR, which takes a while to flow through, right? We are beginning to see a situation where the investment trusts don't look so cheap compared to the unit trusts. And so we worry, or I worry anyway, that over time that outperformance won't continue if it was entirely based on the fees. So where are fee structures going in the investment trust world, and to what extent does it matter?
I think historically there was a fact that investment trusts were cheap. I don't think that's been particularly true in recent years. Some of the older generation of trusts were cheap. What's tended to happen is that fees are under more pressure, and therefore the rest of the world has come down to that level. Yeah. But a lot of the newer alternative funds have quite generous fees and actually are quite expensive. But I don't think it's possible to make sweeping generalisations. I think that a number of a very good solid old style generalist trust, its performance was reasonable because fees were low. But then they were effectively doing the job of an ETF. They weren't that actively managed, and the difference between in those days, going back to the ancient days of Alliance Trust having an expense ratio of 8 basis points.
I know, when readers wrote to tell me about that, I was amazed. We're writing about Alliance Trust a couple of years ago, and I got all these letters from readers saying, did you know their fee used to be 8 basis points? That's 0.08%.
Well, I mean, they had very, very austere offices in Dundee with a lot of brown lino, and the fund was very big, and you didn't have that many highly paid staff. And when you just divided the costs, it came to virtually nothing compared to the size of the fund. But that all changed. But that's another story.
So how do you feel about Aurora, Woodward, etc., having these performance-only structures?
I quite like it, but they haven't proved to be popular. No. The trust I run used to have a performance fee, and we dropped it and raised the general fee from 50 basis points to 65 basis points because that's what the market liked. I have no problem as long as I understand the performance fees. I mean, we have, going back to Berlin Property, Taliesin, which is our second largest holding, has an enormous performance fee. I think they took 11 million. I think the fund manager took 11 million euros home last year.
Structured?
Well, I think it's something along the lines of oversimplistically, the fund manager gets 20% of the uplift and we get 80. But I'd much rather own some 80%. A situation where I'm getting 80% of something that's going up a lot rather than 100% of something that's going nowhere.
Well, I wouldn't mind that as long as when it started collapsing again, they give me back the 20%. What with me giving up all of my 80%?
Yes,
here's the problem. He gets to keep his 20% forever. Your 80% is prone to disappear at any moment.
I think if the fund came back in that case, it would drop back. But we've got plenty of cases where unrealised gains have generated quite large fees. And I think that's possibly the problem why the investment community doesn't like performance fees. If you look at Aurora's managers, if you look at the figures, it's something like they've returned 11% gross over the years, but only 8% net.
Yeah, I mean, they've done extraordinarily enormous respect for the investment style, but the fees they've taken out of there, that's monumental stuff.
That's high. But if they have a difficult time, it will become a low-cost fund.
Yes.
And that's possibly why people don't like it. And I think also the problem is a lot of end users obsess about the level of fees, and they have to declare the level of fees. And if you've got a Taliesin and an Aurora that had very good years that have generated great returns for their shareholders, it's going to make the advisors look expensive on the data that they have to produce. So that's also a reason why
so it's all about image.
Yeah.
Okay, well, let's clear that one up. What about the top funds? Let's go into your favourite investment trust then. We've done German property.
Done German property, yeah.
But your top holding now, you tell me, is not German property, it's India.
India Capital Growth, yeah.
India Capital Growth, okay, tell us about that one.
It's basically had a capital structure that the market didn't understand. It had a very heavy issue of warrants, and therefore it's got a very large overhang. We like India.
Hang on, you better explain that, actually.
Overhang,
Explain
yes.
what that means.
Well, overhang basically means there are far more shares in supply than people actually want, and therefore if supply is greater than demand, the share price needs to fall until buyers are attracted. So hence it trades on a wide discount. So it's a sort of tactical. We're long-term holders. We would be very happy with a 5 or 6% holding in the longer term.
What's the holding now?
It's 8. Post-Brexit, the NAV went up very nicely because the Indian market held up quite well and the pound sunk against the rupee. And we reached the point where the warrants or the subscription shares came to the end, and the undiluted NAV was £1, and we had the right to buy more shares at 61p, as everyone else did. But that created 37 million new shares in a small and liquid trust, and therefore, with all of that supply, with a lot of shareholders owning more than they would like in the short to medium term, the share price has not kept remotely up with the value of the underlying assets. Looking longer term, people describe Modi as India's Thatcher. That I think my view is he's more of a supreme administrator. He's trying to make the existing systems work better. So India is going from an economy that's been incredibly badly run to what I would call less worst.
Okay, so simply using existing systems in a slightly better way rather than actually.
For example, moving a lot of the planning process onto the internet to avoid all the bribery, the corruption, and the bureaucracy. So the system will work better. You've got a stock market that looks vaguely similar to the UK market. They've inherited a system, so you can genuinely stock pick. The top 20 companies in India tend to be owned by the big multinationals, tend to be on very high ratings and often rather unexciting businesses. But you've got several thousand listed companies in India, and therefore you can genuinely stock pick. And the new managers at India Capital Growth, we think, are quite good. The other thing that leads
when they call themselves Capital Growth and Income, that kind of covers everything.
Yes.
What do they mean?
Well, the trust is India Capital Growth. Yeah. So when the trust was launched, historically the trust has been a bit of a disaster. And very often the discount reflects the track record of the vehicle, not the team that are running it at the moment. And India Capital Growth is a prime example of that. Launched about 10 years ago, the first team lost half the money, they left, another team was hired, they repeated the exercise, lost half the money again. Third team came in, I think 3 or 4 years ago, and found a portfolio full of micro caps run by mates of the second team, which took them a long time to sell. And that whole process took the stock eventually from £1 at launch to 29p. So at that point, the market has a very, very poor perception of this trust and view it as a bit of a disaster. But the guys, probably took a year to clean up the portfolio. So over the last 2 or 3 years, it performed very well. It focuses on mid caps, and therefore, they're genuine stock pickers and performed a lot better than the very big general funds that are on offer.
So they're now fully invested in real companies at reasonable prices.
Exactly.
And what's the share price now?
Share price 69p. I think it might have reached 70. NAV.
And what price did you buy at?
Well, we did buy some stock at 29. But the big purchase recently that's taken our weighting up was at 61. It was the exercise of warrants. Yeah, but it's an arbitrage between perception and reality. And we like the macro as well. It's an economy where the central bankers still have tools to use, unlike in the West where we've used all the ammo. Yeah. The economy is growing. You're paying 17, 18 times for the portfolio, but it's typically the earnings are actually growing by 15 to 20%. So it's just a good old-fashioned, profits are going up, stock picking type situation that's very poorly perceived and trades way below its intrinsic value. Okay,
you're taking us all around the world. Where else can we go?
Well, I think the point of the fund is massively diversified by asset class and geography. So Up until Monday, one of the big themes was second-hand life policies in the States.
What do you mean up until Monday?
The proposal put into place to liquidate the portfolio and sell the portfolio to someone else.
Okay.
And it's one of the classic situations at the end of the trust is very often
the wind-up,
etc., which gave us a nice uplift, obviously, because the thing was trading at a reasonable discount up until Monday morning. So that was another area. Biggest theme is private equity, and that's probably, if you include underlying gearing, that's probably 20% of the portfolio. It's interesting; they all trade on wide discounts.
What's the biggest holding there for you?
Biggest one is the Pantheon. I was going to say irredeemables, but they're actually redeemables, which are rising very, very strongly today. I think most of my stocks are normally gloriously unchanged for weeks and months on end. And then you get blips up like Pantheon redeemables today when the rest of the world has spotted it and tried to buy it and push the price up.
Why have they suddenly spotted it? What makes the rest of the world suddenly go, I want that fund Nick's got?
It's just trading on a large discount. You tell enough people about it. Eventually it gets spotted and people start to buy
this is one of the things that a value fund manager ends up having to do, right? Go around the place telling everybody else about the value so that eventually they buy as well and you can get out. Yes. One of the tools in the box. I mean, it doesn't work all the time, but you can help things along by explaining to people what the value is, because obviously you're going out and talking to your own shareholders and you're talking to brokers. Obviously the shares in my trust are traded on the market, so I have to go out and explain to investors what's in the portfolio, and sometimes I go out and buy one or two of the ideas directly. But the idea of private equity, I mean, it's a sector where discounts are still very, very wide. They've been narrowing in recent days. Part of that is because of history. They all blew up in 2008, and a lot of people haven't got the confidence and the nerve to get back involved. Part of it's just coincidence. A lot of these funds have market values of 200, 300, 400 million, which is the dangerous area. It's the area where they're just coming off the buy lists of the big chains, and they're just going into this period of actually having the discounts widen. And I think some of the private equity is just a coincidence that the number of the funds are of that sort of size. But the thing to look at is that there's 1.2 trillion, and I couldn't write that number down if you asked me, of what we call dry capital looking for a home. So the industry globally, the private equity world, has raised vast amounts of money from investors and now need to invest that. If you look at a UK investment trust with a very mature portfolio, if you look at Pantheon, its average age of its underlying investments are 7 years. This stuff is ready to sell into a market that's desperate. So you've got the mother of all sellers markets. So it's a situation where we think the stated NAVs are fairly historic, and that those stated NAVs will have to rise 10 or 15% over the next 18 months as those assets are sold. Yet many of these things are still trading on enormous discounts. So I think there's a number of factors there, and I think talking to people, it's a more difficult concept to get over to investors, and it's not easy. You've got to drill down a little bit. But I think what we've seen recently, there's so much value there that we're starting to get hostile takeover bids. Obviously, you've seen Electra, but SVG was attacked either Monday or Tuesday of this week. And I think what that is people are actually looking harder and delving and thinking, well, there must be value here, and all these things trading at discounts. And I think people are looking over the sector, and we've seen some quite strong runs in some of our stocks over the last 2 or 3 days. Now, with a view to us helping you get out the news about the value in your portfolio, what do you think is the trust that you hold that is the cheapest, has the very most potential in it? If you had to go out tomorrow and buy one of your trusts and only one,
yes, that obviously will put a curse on the future, because I would say that Geiger Counter, which is a very small trust that focuses on, effectively owns uranium and uranium miners.
Yes.
Trades, the discount varies because it's a penny stock. It trades at about 17 pence a share. The NAV is 22, 23p, and those figures move around. But typically it's a 20% discount like other things. Uranium's quite odd because it went into its decline 2 or 3 years before the mining sector did, because of the accident in Fukushima. And sentiment is absolutely dire. Price is quite low, but nobody's looking for new uranium mines. But the uranium is being used up quite fast.
Where is the uranium? Where are the uranium mines in the world?
Half of it's in Kazakhstan. The rest is in Australia, United States, and Canada. And it's an important point because Geiger Counter's mines are all in Australia and the States and Canada.
So low political risk.
So no political risk. For example, there are 100 nuclear reactors in the States. If we have, we have had some upheaval in the stands with the recent departure or death of one of the leaders. That isn't in the price. I'm not necessarily expecting that change, but that you would lose half of your global supply. At the moment, probably there's 20% less uranium being mined than needed by the nuclear industry.
So who's stockpiling it?
Well,
where's it coming from?
Well, at the moment it's coming from Japan.
Right.
They're the sort of they honoured their contracts, and therefore there's a lot of in Japan probably will never come back to nuclear power properly because of the history. And of course, it's not only the nuclear accident happening. There is a history further back, a bit like the Germans can never get around inflation or fear inflation.
The Japanese will always have worry about
exactly.
nuclear.
But that's affected sentiment. But the big users are places like China, India, the United States. So
I suppose what I meant, if 20% more is being used every year than is being mined, where is that 20% coming from?
Well,
somebody has a stockpile. It's coming from Japan. Okay,
because Japan bought into before the nuclear
they bought
accident.
It, now they're just letting it out to the rest of the market.
And then they ended up buying a lot of uranium they didn't need. So in the short term, there's uranium. There's uranium.
But they will run out.
But of course, we're going from say 450 nuclear reactors in the world. The ones that are under current construction are completed. That would be 600, and it may go to 1,000 if things like Hinkley Point, which is looking more likely this morning.
Which was supposed to be approved this morning.
Yes, which would be in that list between 600 and 1,000, the ones that might make it, but most won't, if you see what I mean. So let's say we end up in 5 years' time with 650, 700 nuclear reactors. We're not even mining enough 450, and the mining supply will keep dropping every year as things get exhausted. Nobody's going to actually even look for a new uranium mine until it's $70 or $80. So we're going to get this massive spike up in the price at some point. I'm just surprised it hasn't happened already.
But this trust has been languishing for years and years and years,
oh, yes.
hasn't it? I mean,
yes.
You're not the first person to have told me how wonderful it is, and I'm sure you're right. But will it last the course, or is it going to be one of your wind-ups?
Probably not now that I've tipped it as my as my selection. I have a fondness for it because we sold half the holding. Little did we know, but I think the tidal wave was heading towards the nuclear power station at the moment we sold, and we sold half our holding at £1.35. And I used to joke that now it was the same, but just taking the one off the front. But it's done that and halved again. Okay. But I think it's just a case of
waiting.
I can't see where the supply is going to come from. And we mentioned earlier the Kazakhstan situation. Half of this supply comes from Kazakhstan. If there is a political change, there is upheaval. No reason to say there should be, but that would have an absolute dramatic effect because we're already in shortage. Yeah. And then if half the supply disappears, so you can see there's ever more demand and there's ever less supply, and it's hated, and that's why it trades on a discount, and why all the underlying stocks trade on a discount.
Okay. Well, given that you've cursed it,
you
better give us another. What would be your second choice?
I think the second choice is probably Taliesin still. I mean, people may find that odd.
But you've made a lot of money out of that.
Yeah, no, we started buying at £7. It's now 31.
Yeah.
But I think, you've got one. I think the bull market in Berlin runs for years and years and years. It's almost without parallel that a city can go from an urban wilderness as it was 25 years ago to being a major European capital. And when you look at the prices, it's still a seventh of London is the rough price of Berlin.
And so is it Brexit buy?
Well, it's worked very nicely as a result of Brexit and the pound heading low in the short term. So it's still cheap. I think demand will keep going because in Germany, people who are sort of 40 and under, they are global. They are buying property. I mean, the 50-somethings, the 60-somethings will carry on renting because that's the culture. So there is a generational change, which is more extreme in Berlin because it is a sort of happening place, and that's come from a very low level. But there are other things. There's one that, as Taliesin sells properties and hands money back to shareholders, I'm reinvesting that money because if you think they're selling at €4,000 a square metre and they're valuing in their particular case at 2,400, you may as well just put the money back in. But the other thing that's not talked about much is that, like in private client stockbroking, the pots of money that have managed to become big, it's the same in the property world. There's been consolidation. So property managers, investors need very big tickets, and therefore the value for a portfolio is vastly more than the value for an individual building. Yeah. Yet the NAVs are calculated by what those buildings would fetch individually, not as part of the portfolio. So there's another discount there. And we had a situation called Japan Residential, which was a similar company owning apartment blocks in Tokyo, where the NAV was 54, but Blackstone, perfectly logical buyer, paid 72p cash because it would have taken them years to build that much more. And therefore, that's another situation with Taliesin. And
are there any trusts in Japanese property at the moment that are interesting?
No. I don't think there are any, which is sad because it is a sector. There is one, Prospect Japan will give you some access. That's a very specialist fund, and at the moment their big bet is trying to get control of the 2 banks in Fukushima. Because Fukushima, I don't know the size of it, but it was probably on a par with Devon and Cornwall. It's had $100 billion pumped into it after the accident. So the economy there is ticking over fine. So the banks are in a better state. But the manager there has managed to buy in at 30% of book. And I suppose his plan is that if the authorities don't particularly want a Western investor in a sensitive bank, they might buy him out. But the rest of the portfolio is pretty well focused at businesses, a bit like we did in the 80s. Spinning mills and things like that, own vast tracts of Tokyo for a business that was industrial and not really being used. And he's got a lot of companies, cheap property, overlooked property, and that's the only way. But
there's quite a conversion challenge there.
But if you're only getting half of Japan property, you've got to take a view on 2 banks in Fukushima that own, which is about half the portfolio. So
we'll stick with Germany for now.
Yeah.
Okay, Nick, I better let you go. I think we've been on this for a while. But thank you very much. So
Not
everybody, that's uranium, Germany, and India in a nutshell.
Yeah.
Thank you, Nick.
Not at all.